Right, can you hear me now? It says I'm live. Lord knows if I am. Apologies for all those who might have left the room. Let me know if you can hear me. If you can't hear me, then yeah. You can hear me. So, wow, sound. There we go. Mungie, I know. It's so basic sound, isn't it? You should see how complicated it actually is when you've got a quantum computer with 15 graphics cards in it and 200 screens and 500 different microphones for different purposes. We're here now. It's amazing. Right. God knows what happened. Back up. Next time, I'm going to make sure the bloody thing's plugged in and ready as a backup. Just when I got rid of it as well today. Anyway, sorry about all of that. I think what I'll do next time is also test it beforehand. I know. Right, now, I want you to see the screens. Let us make up for some lost time. You should be able to see the screen on here. And I've gone to quite a bit of trouble to get the slides. Well, there's some really good ones in here, so read all of that. But let's just start off with the size of the relative stock markets. In terms of, obviously, somebody's shown this to Donald Trump, and he's obviously come to the conclusion, why the hell should we work in a world where we work together when, listen, get off my beach, take my orders, I'm 10 times bigger than all of you, any one of you put together. And, in international relations, these things happen, but it does put into context just how big they are. And what I want to do is focus very much on the stock market, obviously, and you can see how big that is for the Americans compared to anybody else, and why they just have that massive advantage. Now, I want one of you or two of you, or however many you want, just keep an eye on the NVIDIA results for me, will you? Because that's the biggie in terms of what's happening in the markets. Now, for me, as those of you who follow me, look, if you're on the program, don't have a heart attack that I'm going to disclose what people will often already know, that I have NVIDIA, okay? And so does my son, and so does my wife, amongst the various other stocks they have in our portfolio. And for me, it is irrelevant whether it beats its earnings estimates or not, and whether earnings are increasing or not, because I'm not trading it. I'm not trading before the news. I'm not trading after news. If I was trading, I'd care. I'd be looking at the screen. I'd be going, right, let's go short now. Let's go long. It's a different mindset. It's a different game. Okay. When I'm investing, all I'm thinking is, well, it's a company either I want or I don't want. One of the best ways I found to make decisions very easy is you get to a point where they're binary, on or off. I'm on. I'm in this. That's it. End of story. Good night. And that's my attitude with it. So, it'll be interesting to see what happens tonight, and it will be important for the market's tone and so on. But if you start caring, it means that you're either gambling or you're trading, which is different to investing. And I'm investing. Okay, Martin, I don't know what it was with the mic. Honestly, I swear to God, I do not know. It had put a default onto some other software, which I then uninstalled, which I'd installed yesterday. Now, where are we on market cap? Now, again, those who've been following me, in the public domain, I have mentioned, and it won't take a genius who follows me closely to know, that whilst I have a small amount in Bitcoin, it's a buy and forget, and it's not part of my pension. It's sort of FOMO. That's why it's there. I'm not a Bitcoin expert. I treat it like I would if I bought modern art. In other words, I'm a Philistine. No idea whether it'll do well or not. And I don't need convincing either way by somebody that, it's going to be amazing. In fact, I get worried by hardcore convincers. It usually means they're trying to convince themselves of something. Yes, you know that these I have. You know why I don't have Tesla, because whilst I think it will do well, the volatility I don't need. You'll know I have this, and I mentioned that already, and I'm a big fan of this. You might know that I don't happen to have that, so be it. Not for any particular negative reasons, can't buy everything. Anyway, those are some of that puts Bitcoin in context. It's $2.1 trillion. Small in many ways, given that these other companies are bigger than it, yet Bitcoin sort of takes all the oxygen in the room, doesn't it, very often? This I came across, which I wanted to share with you. Harvard Endowment Public Holdings Portfolio, second quarter 2025. Interesting what they've got. So that's Broadcom, which we just looked at, NVIDIA, Meta, Alphabet, Microsoft. Okay, on the ETFs, now this is the bit I wanted to show you. They've really picked up their holdings of Bitcoin ETFs, okay, and gold, but Bitcoin in particular, and that's Harvard. And obviously the US government and Donald Trump's family in particular are picking up Bitcoin. They've done a deal. I think the Trump family personally have done a deal with the government of Pakistan as well on cryptocurrency. And I'm pretty sure they're looking to do deals with other countries on cryptocurrency as a way of, I mean, I don't know, in America, you get away with it. You know, if I was politically exposed and try and buy £1 of Bitcoin, I'd probably have the feds on my back in 2 seconds. But hey, if you're the president or their family, apparently it's okay. Those kind of things will push that higher. Amazon, Booking.com, interestingly, it's been a popular one with hedge funds for a long time. Anyway, I just thought I'd share that one with you. Harvard's endowment goes big on Bitcoin and gold in second quarter 2025. That's up to them. They're obviously thinking something. Okay, Munchit said, why are gold spot price about 10% out on, say, iShare Gold ETF, spot price 10% higher than the ETF? Well, you've got an arbitrage opportunity there. I'll look into that. There's usually something to do with how the ETF is funded, or just the fact that somebody's anticipating that the price will fall, perhaps. And honestly, short answer, I don't know. I need to look into the technical reasons why on that. Now, S&P 500 performance after Fed rate cut. Now, this is actually, would you believe, the actual news item, which is probably driving the markets, not the other political stuff, which I'll come to in a second. This anticipation of a Fed rate cut is more about what Wall Street is interested in to drive markets higher. The good news is 1 year after any cut, the markets are up. And the next cut is anticipated in September. Even if it doesn't happen in September and happens in October, the market's getting that carrot. And we're in an environment where the market is happier if rate cuts are coming. There are times when it gets worried if rate cuts are coming. We don't have to worry about those times. But right now, we're in the ones where we're in a bit of a sweet spot. Sweet spots never last. The market is an unstable environment. And so anyway, this is good news for us, is my bottom line. What also is good news, and you're going to think, this is boring. Why the hell are you showing me US debt growth at 9:23 UK time? Let me tell you something incredible which has happened and you may well have missed. Okay, and I'm trying to tell you stuff you will have missed. The Bitcoin thing you might have missed in terms of what the Trump family is doing and what they're pushing internally through the US government as a branch of Trump Inc. To push prices up. But separate to that, the tariffs, and Scott Bessent, the US Treasury Secretary, said today that they've pulled in something like $30 billion in extra tax on US consumers or US businesses, whoever's paying those tariffs, okay, in America, and it's Americans paying the tariffs. So by raising taxes, they've pulled in cash into, and that means they're going to reduce this deficit. Now, the deficit is how much they fall short each year. The debt is in absolute terms how much is accumulated over the years. And the deficit is, if his numbers are to be believed, and I'm not too sure about US Treasury, I think it's becoming increasingly like the Chinese Politburo, where I'm a bit unsure about their numbers. If these numbers are correct, they're going to hit about a deficit of just 3.5%. If they hit 3.5% budget deficit in the US, that'd be their 50-year average. That's the average over the last 50 years. If that happens, then the stock market is going to be less worried about US debt. It's going to be less worried about pretty much anything, actually. and it's going to be really good for them. So if this tariff thing in the short term works, in the longer term, it might have damage to US trade, US relations, blah, 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 blah. But in the short term, if it works, that could be another boost. And that was something which the US Treasury Secretary had talked about. Like I said, they get overexcited about it, but that's also good news for stocks. Okay. I'm just telling you the way it is. I'm not trying to sell you a stock. I'm just telling you the way I see it. And I've got to be objective. If I'm ever not objective because of political views or anything else, the first person to feel the pain would be me, because I would make a bad judgment. Okay. So looking at the data, that looks positive if the Americans are right. Now, God knows the rest of the world wants America to be wrong on tariffs, obviously, because the rest of the world is saying, why are you tariffing us? They want it to be wrong. But that's irrelevant to my considerations of whether or not they're right or wrong. It looks like if those numbers are to be believed, and of course they would say that, wouldn't they, the Americans, they might be reducing their deficit, which we'll see. It's a big American experiment. We'll see what happens. People are selling it. Yeah, well, I guess because of the run-up. We'll see what happens with it. It could go all over the place, Martin. Honestly, today, I think NVIDIA as well. And I think it'll be buy the dip. Alpesh, for us, peasants not on the get, please can you ignore any fussy client with reference to... Well, I've told you quite a few already. I understand, Marcus. I know. I hear you, Marcus. I hear you. But I've told you quite a few already, and there's a few more coming. Largest government Bitcoin holdings. Now, you might not be aware that the US government holds $13 billion. I mean, Trump family probably has a similar number of coins. They issued a whole bunch beforehand. It reminds me of the Marcoses, Imelda and her husband, with the shoe collection. The Trump family collects cryptocurrency coins. And the Chinese have got that much. I suspect they've got a bucket load more than that. The Brits were not doing too badly. Of course, we'll wait to sell that at the bottom of the market, I'm sure, at some point, as we did with gold. Forgive my cynicism. And these are the biggest. Now, we're going to talk about stocks in a second. Like I said, Bitcoin, I don't think it's suitable for a pension. You might think differently. So, look, whatever I hold in this is a rounding error. It's not part of my pension. It is there more for fun. Ethereum. My wife asked me just recently, she goes, "Oh, Bitcoin's doing wrong. How much have we got?" I said, "I have no bloody idea. But all I'll tell you, sweetheart, is it's not enough to put you in clover." Okay. XRP, as you know, I've got a bit of. And I think I had some Solana, which I don't think is up. By the way, my XRP is only up this year, net, from last 7 years. So I've been underwater for 7 years. Hence why I'm telling you, I'm not the crypto person to speak to. You might as well ask me about fine art instead. I'm also ignorant about that. And fine wine, ignorant about that as well. UK, all companies. Now, I want to show you this because I'm not sure if I showed you this last time. Just be careful if you've got these dog funds. £100, you didn't get £72 on it with these funds. You were left with £72. £100 became £72. That's the LNG future index, future world. So just be careful. Take a photo of this. Get your camera phone. Got mine. Take a photo of any of this. Okay. Thanks for giving me updated on NVIDIA. Sarah, what platform did I use to buy Bitcoin? So originally I used those bloody complicated. Can you give us 16 different passwords? God knows what they'll call it. It wasn't Coinbase. It was one of those popular ones, literally where you could have it saved in a cold wallet. And then I just did something stupid and simple, like two main places, Revolut and eToro, which I know is not the cheapest place to do it. But like I said, I'm not the specialist in this. I've got friends who've done it. They've done trading on those exchanges. And they have to. And so I did do that all initially. And I remember buying quite a bit initially, actually, in all the hoopla in 2018, and then selling some of it, and it was mental. It was the password stuff which just drove me to insanity. So just watch out for these and look at how poorly over 3 years they did. Now, the reason is not because they're necessarily incompetent. People ask me, they say, well, it's all very well picking one fund which has done poorly. It is systematic, it is institutionalized. And the reason for that is, 2022, obviously they took a massive hit. So the way the fund management industry works is because they get paid on fees for assets under management. They have to get as many fees as possible through getting as many assets under possible. Now, if you're going to get a lot of assets under management, you're going to have funds which are, I've told you this before, divided by geography, style, and theme. And so you're picking from a very narrow gene pool, which means you'll necessarily have years you can't avoid it because you pick from a narrow gene pool where it's going to be rubbish. Now, what they tend to do, and I know this because I'm in the asset management business, is on the up months or years, they will advertise like mental, okay? And luckily for them, 5 years are up. And then snakes and ladders, they go back down here like 2022 and they lose you money. And that's the year they don't necessarily need to advertise, and they just pull out the old folder about excuses and bullshit. Okay, but that's no good for you because all this time you thought you could retire early. And we know this is the case because here's the data and the numbers in front of you for the last 3 years. 3 years, which incidentally were some of the best years in the US stock market. And you might say, well, you're just picking on the UK. Well, most of your pension funds will be in UK stocks. So just be careful that you're well aware of this. Now, you might say, well, what's the answer? Can't we find a better one? Well, one answer is you need to just watch this webinar and watch out for years like 2022, which I'll show you in a second, where it's better off to hold cash. Now, luckily, they happen infrequently, and you would have done a bit better if you could have just held cash for most of that year, not trying to pick tops and bottoms, just held cash. That's one way. The other thing is, if you're willing, roll your own. In other words, pick your own stocks where you're not restricted by, oh, I'll only pick UK ones or just European ones or just Vietnamese ones. And we'll get into that later. I've said it before. So I'll give you an example. This is the S&P and this is the FTSE. Okay, 2025 to date, that's their respective returns, and then so on. All right, 26 and so on. And you can see generally the US does significantly better than the UK, though the UK might some years do a little bit better than the US, but overall you're better off in America, even allowing for, people go, well, what about exchange rate risk then? Well, you look at those two sets of numbers and you tell me, well, what about the extra £1.50 I've got to pay for hold those American companies then? Well, you look at the, sorry for the voice, it just keeps me entertained if nothing else. So you look at those numbers. What we do when we're creating this is 44 stocks which my wife and son are in, okay? And that's what we're after. We're ideally after an absolute positive return if we can. Sadly, I wish I could guarantee that, because if I could guarantee anything, I'd be the richest man on the planet. But I want to show you something. Look at the variance. Look at how low. And by the way, that doesn't mean every month was positive. Oh my God, no. It would be like this, wouldn't it? So I just wanted to show some of that and show the US and UK. And that's why I think the first step is I'd rather be in the US than the UK. And I wrote that in the Financial Times column, my first one 25 years ago. And the second thing is I'd rather be rolling my own. Okay, so I want to make those points to you first of all. And you can even see when we try to make a UK model portfolio with exchange traded funds, it's not phenomenal. All right, it's not, great, fantastic. Compared to just, this is US, this is just purely American. All right. Oh, and Europeans not been surprisingly good, by the way. I'm not, look, I can't have everything, so I don't actually have European exposure, but it's there, the model that we created there. This is Warren Buffett's portfolio, just in case you're interested. He sold out of T-Mobile. Now, he bought into United Health, as you might know, and he rebalanced and sold some Apple. Okay, it doesn't mean he doesn't like Apple. If he didn't like it, he'd have done this, wouldn't he? He would have done that. Nobody talks about the fact that he sold out completely. He just reduces Apple by a little bit, and everyone's like, oh my God, he hates Apple, which obviously isn't the case. Right, so you might want to take a picture of that if you wish. Let's have a look at this. These are US shares which are up more than 200% year to date. I don't own any of them, just so you know. I don't plan on owning any of them because I can't research every single damn thing that's out there. I'll give you an idea. This is the UK FTSE 100. Now, sometimes some of my students, this is the point at which they have a heart attack. They go, oh, you're showing the filtered list. Well, I'm not actually. I'm showing you all the ones which don't meet our criteria. So our criteria has to be green along all these 5 criteria: value, growth, income, cash return on capital invested. That's this one. 6 months, they have to be up. Sortino, high average return versus low volatility. And what I'm saying is one of the reasons I don't like the UK is, well, first of all, the big companies, there's only 100 of them, And the vast majority are just not there. Now, you might reverse engineer this and say, well, wait a minute, where are the 7s? Even if I can get a 7 up here, it's very, very rare you get something which, I mean, we still haven't. I mean, how much further are we going to have to go up? Look, it's very difficult to find a company, as you can see, which is, there isn't one on the screen. So for those clients who might be watching, don't have a heart attack, there's none of these which fit. And the reason for having stringent criteria is, well, think of it like this. It's your kid's pension, inheritance, your pension, their inheritance. So you want to have strict criteria. Well, why these? So these I've written 200 columns in the Financial Times, and I used to fill up the space, look at the academic research and the research coming out of the investment banks, not the stock picks, the research coming out, which was saying, well, hedge funds use Sortino because that shows you which companies consistently do well and have very little volatility to the downside. It was a bit of a trick, a cheat to look at the stock prices. Cash return on capital invested was invented by Deutsche Bank, and Goldman Sachs Wealth Management use it for their richest clients. So you've got 50 million, they'll do it for you. And they found companies which were green there tended to do better, significantly better than those that weren't. But we wanted to also look for undervalued high growth companies. Okay, so I'll show you more of that a little bit later on. But the point being, I'm trying to pick a portfolio which is going to give the returns you saw earlier. I am not trying to pick the 10 baggers or the 200 year-to-date ones. Put another way, Warren Buffett became the world's richest man without ever, in any given year, having stocks which were the best performers in the stock market that year. He never, ever had a stock which was top of the table. Okay, probably not even in the top 10 for that year. Similarly, I never had these. And that'd be a different game to play. And it's because there's different things to do in the market that people get confused and have a hodgepodge strategy. You find one strategy, you stick to it. Ours is value, growth, income, Sortino, cash flow, and then we go to sleep. Okay? Because we have peace of mind. We're not, now, if somebody said to me, no, I want you to try and find this, I could probably do it as a little game and I'd probably be mediocre at it. Okay, I'd probably be a little bit good, a little bit bad. Not my game. It's like saying, well, you can play, you're good at paddleboard. Have you thought about entering in Wimbledon? So sorry, it's similar, but not the same. So you stick to your lane. Now, before I get into more of the stocks and where we are on the stock market update and the political stuff as well, one of the things that I want to show you is just the commandments of investing. And I said each week I'll go through a different one. So this month I'm going to go through the monthly myth. Portfolios do not generate in a month 1/12 of their average long-term average return. So if we've got a portfolio which, let's say on average, the mean, arithmetic mean was 15%, 20%, 25, 30, 40, whatever. Okay, it doesn't mean after a month you're going to get 1/12 of that average. Okay, now you might say, well, it's bloody obvious. You'd be surprised at how many people think it's a bank account. The stock market isn't a bank account. I had somebody this week ask me, who we were having a call, and then he signed up to the program. And the question he asked me is, how much money should I put in to the stocks in the program so that in, say, 3 to 4 months, I could withdraw £2,000? And I said, nothing. I said, what? I said, well, nothing. Because what you've just told me is you want to gamble for income in a short time frame and have some sort of guarantee. That's all the red flag markers of a gambler. I said, sorry, it's not trading, it's investing. In 3, 4, whatever I tell you, if you are wrong and in 3, 4, or the market takes longer, in 3, 4 months you haven't got that, you're going to be in mental anguish and panicking. It's far more sensible and accurate for me to say, well, no, if you need £2,000 in 3 months, put it in your bank account now. Which came as a shock to him. Obviously, he then signed up because I guess he could tell, well, actually, that bloody makes sense. The guy's telling me the truth. He's not telling me what I want to hear, which is, oh, yeah, no, it was very high likelihood you could do that. And it may well be he does get that in 2 to 3 months. But my God, if he's relying on it and thinking like that, he's going to blow up. Because what happens after the next 3 months? And the 3 months after that? He'd have to keep on doubling up his bet like at Vegas because he hit red. until he's lost it all. And so I've got to stop them thinking stupidly and gambling from day one. And that's that. A lot of these seem to be pharma stocks, which are very unpredictable. Well, Marcus, you're absolutely right. And I don't want the volatility. Do you see what I'm trying to teach you is, listen, it's okay not to have that excitement. It's a bit like living in Canada. Just because they look like they're having fun in America, don't feel like, oh God, I'm Canadian. And just because Vegas is having fun, it doesn't matter that you're living in Florida. Okay, now we'll do the other commandments. We'll do a new one each week. Where are we on the S&P 500? This is exciting. Look at that. We're still going up. What the hell? It's pattern recognition. It's very similar. This is, you will know, weekly and monthly prices. For those who don't know where I get this from, well, it's here. Look, it tells you. For goodness sake, it's written on the tin. I like this, actually, the website. And I've used a lot of different types of software. It's not to say other software is bad. It's just some things you like. I'm happy to like this. I'm not affiliated or linked them and never even reached out to them. The MACD is just a measure of, a simple way to think of it is short and medium term prices, historic prices, okay, average prices. And think of it as pattern recognition, okay? You can ignore it if you wish. And what happened here is we got a daddy bear. What's a daddy bear? It's when the green crosses below the blue. Why is that a daddy bear, Alpesh? Well, because that's the kind of bear market where I want to be out of, and the falls are likely to be bigger. And it happens rarely, thankfully, and January 2022 was one of them. And another client of mine, somebody who's actually on the program, asked me today, I think it was, I answered the email. He said, what if American markets collapse? And quite a few clients have asked this in the past. And I said, yeah, we should be humble enough to know that today could be the peak of the market and it's never going to go up again. And tomorrow there's going to be a nuclear bomb and we're all going to be dead. So you're absolutely right. And it comes as a bit of shock to them because they think I'm going to guarantee their lives. And I'm not. They might not wake up tomorrow. It comes as a shock to them that I tell them this. I say, you might not wake up tomorrow. So let's go back to probabilities. The probability tables say that, you know, you're 54 and you're likely to live to 75. So if I look at the probability tables of this and I go backwards and backwards, this tends to happen once every 5 years, okay? And this tends to be, I said, as good a thing that I found as anything else. 300 programs on Bloomberg television, and I've been using the same measurements and in all the books. And I said, look, they're not guaranteed to work, because if they were, I'd be the richest man in the world, but they're pretty bloody good. And I said, why don't you go on a free tool like Yahoo and look back over history, and you'll see it tends to be as good as, you know, talking head on TV, actually a lot better than those, and some analysts, and certainly better than any of the investment bankers who'll always want to talk up the market. You know, they were talking it up here. I couldn't talk it up there, although I didn't know which way it was going to go. I just said, oh, this looks like it's going to fall. And when that happened here, I want to teach you a very important lesson. I had to pay an insurance premium because I had to get out of the market because it was a daddy bear, and I was fearing it was going to do this as it did in 2022. But when I had to buy back again because it wasn't a daddy bear, that difference between the sell price and the buy price, that extra money I had to pay, is an insurance premium. An insurance premium that the house might burn down. The house didn't burn down. Does that mean every time I pay insurance for my house against fire and theft and collapse, and it doesn't fall? By the way, never in my history, and 54 years on this earth since when I had the first property, 23, has any of my houses ever burnt down or anything else? So have I been an idiot for the last 30 years getting house insurance? No, I've had personal peace of mind. That's my job. You might say, fool, we've made a lot more money than you, and you would have done had you not bought insurance. My economics tutor at university used to say, no, we don't buy insurance because if they're selling it to you, you shouldn't have it. And I thought, yes, that's an economist, but that's not a human. Anyway, so I bought that insurance and it cost me, but it's fine because all things are fine now and we're going up. Will we continue going up? I do not know. I do not know. What I know is that's where we are. Don't overpredict. What private investors do is they look at this and they say, well, it could do that, so I'll just get out now. They prematurely evacuate the market. Don't prematurely evacuate. It's not good. Wait. That's why I do these broadcasts weekly. Okay? Past week. This is where it's been. Don't read too much into the past week. We're not trading. We're investing. It's noise. You know, sometimes I get people saying, we're rotating out of consumer defensives and it looks like we're going into semiconductors. Well, I quite like to be in semis anyway. Oh, and healthcare's sort of, well, bits of it are picking up, blah, blah, blah. Well, you're reading too much into it. Humans have a tendency to see patterns where they don't exist. Okay, they mistake coincidence for correlation, etc., etc. You'll know this, but the level with which they do it. So I'm not bothered about the past week. Past year's been good. I expect in the next 5 years, 3 years, we'll get another year which looks just like this, except the numbers will be different. As in, it won't be Walmart that goes up 27%. It might be Amazon, which goes up 27, and Walmart only goes up 29, for instance. You know what I mean? We mix it up. That stands out. That's not because that's a rubbish company. That's because these companies go in cycles. And I like it. I'm happy to have it. And people go, but that's not a 200% gainer, is it? It's not the one which is going to be the top performer. No. But it'll make me the richest man in the world like it did Warren Buffett, because over a period of time, I don't have to pick the top performer. That's a far more difficult task. I just have to keep making sure I don't make dumbass mistakes and keep doing that over a number of years. And the boring tortoise wins the race. Okay? Yorkshireman, indeed, I am. So if you said to me, well, what about Broadcom? Is it going to do another 83%? I don't know, but I will decide based on value, growth, income, cash flow, Sortino. Do I want it in? Binary decision. Do I want it in? Do I want it out? And then what does the portfolio as a whole look like? Okay. And I have something interesting with some of our portfolios. And this surprises me as much as anyone else. You might think, how can that surprise you, given that you're supposed to be the expert, Alpesh? No, forget expertise. Expertise is only based on somebody looking at something more than somebody else. That's all. So if I don't look at the data, then I'm not an expert anyway. So when I find new data and I look at it, I go, shit, I can't believe it. And I'll tell you the data, which was interesting. So if we put, for argument's sake, let's say we put all of these into a portfolio, the shocking thing that comes out is, let's say the average of that portfolio's returns over the last 15 years was 30% per annum. Just historic fact, take it as given for the moment. The shocking thing is something which Warren Buffett, the bloody genius, said. He said, if you can't bear a stock to fall 50%, you've no business being in the stock market. And I thought to myself initially, like all his statements, it initially seems trivial and stupid until you understand what he's really saying. What he's really saying is, if you take a portfolio as a whole, then like him, he's not good enough to pick a stock, neither am I or anybody else, which will only go up and might not drop. But you don't care if it drops 50%, because in the portfolio as a whole, you're still averaging 20%, 15, 25, whatever his long-term average is. I think it's 22%. Okay, so we know he's done that. But he did it because he did two things: didn't panic and didn't get bored. But you can only do that with quality companies. The private investor doesn't think like that. Private investor thinks, I want the very best stocks and it should only go up. And if it drops, I'm going to panic. Okay, that's why they mess it up. You could actually give a private investor, and a hedge fund manager famously said this, Richard Dennis, in the 1980s. He said, I could put all the rules on the front page of the New York Times, and Richard Dennis is filthy rich in investing and trading. And he said, and retail clients still won't follow it. Okay, it's just how they are, because they love to gamble. Or maybe they don't have mentors. I don't know. Anyway, so I just want to give you a bit of background where we are. How are we over the last year? This is where we are. We're up nearly 20% on the NASDAQ. And the NASDAQ, you better believe, is, well, basically, it's which is the best football team in the world? Oh, God, don't say bloody Arsenal. Who won the World Club competition? Please don't say Arsenal, because they just gave us a 5-0 drubbing. Whoever's the best club in the world, who just won that competition recently, NASDAQ is it. It's the Real Madrid, or the Barcelona, or the Leeds United. Oh, I wish. The thing is that still, I want to show you something. That's a collection. That's the Premiership of football, or whatever you want to call it. That's Brazil. That's Brazil. This is Brazil. What? Boredom. That's the boredom. That's the panic. Right? Boredom and panic. That's why you mess it up. How come you didn't get 20%? Even better, how come with a 2 times leverage, I'm not recommending you do that, you didn't get closer to 40? There's technical reasons you wouldn't have got exactly double. But how come? Boredom and panic. Of course you're going to panic. And don't tell me in February, oh, no, I won't panic. That when you're looking at a chart, everybody's all relaxed. It's like they've taken a lot of the CBD gummies. But trust me, when that happens in the market, oh, no. Yeah, you're in the lavatory as much as the next guy. Okay. So here we are. Top gainers this week. As you know my holding on that. I've already discussed that. I can't remember that one. Honestly, can't remember. We will do a UK one on just the UK generally. I'll do a separate webinar for that, as I've said. So where are we on the FTSE 100? Well, it's trudging along quite nicely. It's overbought, but it's trudging along and may well keep going along nicely. My God, in April, it was at 2019 levels. So it's made 5 years worth of gains in 4 months. Not for me, thank you. I can do without that kind of boredom and then sudden bloody excitement. I can't wait that long for my plants to grow. It's like one of those rare plants in Kew Gardens, which only blossoms once every 80 years. Anyway, here we are. Yeah, Marcus, that's interesting. I didn't know that. He said only 12 stocks moved the needle for Berkshire in 58 years, so one stock every 5 years. I'll look into that. Was it Chelsea? Wow. Okay. Well, I'm glad it wasn't bloody Arsenal. Anyway, so there we go. Yeah, Oscar, I've got a whole load of information on getting jobs in the hedge fund industry or setting one up for free. You just go to here. I'll put it on here. It's all free, and I've put a whole load of interview questions and everything else on there. So if you want the hedge fund industry stuff, I just saw that. Apple. Whoops. Wait a second. Now, for those on my program, I'm just showing a little bit of ankle. Okay. What with Apple I've been waiting for, as you will know, is this to flatten out, because this is rising. This is the shorter term prices. This is the sort of slightly longer term. I need this to flatten out, and it's difficult to know whether it has or not. I'm happy to call that the bottom. September, I think they're going to have wonderful announcements. I think they're producing a whole load of iPhones in India, which hopefully will be those foldable types, and I'll be at the front of the queue to buy yet another iPhone. But anyway, whatever it is, it's difficult to know whether it's quite flattened out, and it has been almost relatively sideways for a while. If you don't like it, if in doubt, leave it out. That's another important lesson. You're not forced into a big brand name. If you don't like it, for whatever reason, leave it out. There's plenty more babes in the sea. Okay? Let me show you what the analysts think. Not that I care, because they're renowned to be inaccurate. But this is where we are with the 12-month forecast on it, and some think it could go as high as that. Others think it could drop there. Well, that tells you something about the quality of analysts, I guess. And they're all educated at the same universities. They all wear the same gilets, waistcoats, body warmers. Okay, they all go shopping at the same place, right? And yet, look at that. That's nuts. You'd think there'd be some kind of agreement when you. Anyway, that's where we are. 15 of them say buy. One says they rarely say anything other than buy. The industry is just so I don't know, rubbish at it. But let's look at Amazon. Amazon price target, according to the average analyst, is at least a bit more room to the upside. Now, I was looking at this earlier, and don't read too much into this, but imagine if there was a correlation between the analysts and if you're near the top here or near the bottom, and whether you should buy or sell. Well, that's how trading strategies are created. So the way trading strategies are created, and if it's over a longer term investment strategy, is there a correlation between this being at, say, 100% or whatever number you want to pick, and that being the buy zone, and then it being down here and that being the sell zone. So you develop a hypothesis based upon observation, and then, just like the scientific approach, observation, hypothesis, bit more observation out of sample. So you test the hypothesis, and you look to see if you've got enough data in there for some statistically significant results. And it's not just too little data, which is usually the case. Anyway, I've not done that. I'm not planning to do that. I'm pretty happy with the way we do things, but I just wanted to show you that out of interest. And that's where the average analyst is, and that's what they think, and so be it. Good news for them. It doesn't really bother me. You might see all sorts of other patterns. You might see that when this gap gets really wide, which is what I'm saying, it's a good idea to buy, or if it gets beyond a certain percentage, you should buy. And you can test that hypothesis if you so wish. There's a million hypotheses you could test. There's a million ways of doing things. We stick to one. We have our one, we stick to it. Okay, we have this, we stick to it. Why? Well, because there's roses to be smelt, which is far more important than being sitting in front of a computer screen all day long. Okay, Microsoft. Where is that? This is where it is. I like Microsoft, but it's overbought, but it's fine. I'm not trading it. I'll hold it. But others would say, nah, boring. Pay you the big bucks for that. Bit dull. It's all right for my son and wife. Well, they have the 2 times leverage in it, so it gives them a bit more zip. And I wanted to show it because it was one of the few with a very big, wide price target. Now, that's a pretty dull one. If you're expecting me to say, hey, and I could do this, give you a little narrative about a tiny little quantum computing company which is just cracked through quantum computers breaking secret codes, passwords, which means virtually no computer database is secure in the world. I could give you that company name and say to you, I think they're going to be huge. I think they're going to have to be bought out by the American government, or somebody's going to have to kill the founders because they've just cracked that problem. Quantum computing can do that. It can crack any password. And you'd say, really? And that's the power of stories and narrative. Speaking of which, what I'm describing to you is the storyline from the Robert Redford movie Sneakers. It hasn't happened. Might do, but it hasn't happened. My point is, I'm not swayed by narratives and story. I like data. Okay. By the way, in terms of that whole Microsoft thing, that's where it is. I don't mind it. I know it's a bit dull, but I don't mind it. Okay. Yes, exactly, Marcus. Broken clock, right, twice a day, like the analysts. Thank you. And that's the NVIDIA one. Hardly any to the upside, they say, and look where it is. Now, what's happened in the past when it's been like that? Well, it's gone sideways for a while. So is NVIDIA going to have an Apple type of year where it's pretty much flat for 12 months? Well, it has done in the past when it's been like this. Well, I guess there it sort of didn't, hasn't it? Is that flat? No, that went up. So not a strong rule. Actually, yeah, more often than not, when it's down here, on balance of probabilities, the next 12 months, it's flat. Do I think it's going to be flat over the next 12 months? I'm holding it. So if it is, it doesn't matter because it's about a portfolio. If it is slacking in the next 12 months, as Apple did in my portfolio, something else will make up for it. Do you see how it's not about the breathless headline, as Warren Buffett called it, and the journalist goes, I've got 40 stocks or 20, and they're all going to be amazing and triple-digit rises. It's not bloody Seeking Alpha or something. Novo Nordisk. No. Got to wait for that to bottom out. That might well be the bottom of it. Might be. I don't know. But not for me at the moment, even though it looks ridiculously cheap. Can you believe it? Year after year, and I've only shown it to 2019, just did this. And is it cheap? Yeah, on a price earnings, but not yet, not for me. And it's interesting, the analysts are getting a bit more boisterous about it, and they think upside as well. Well, we shall see. But here's the interesting thing. Look at that. Okay, so when it was just about to start its big collapse, they always predicted wrongly. There's your analysts. The price targets were always higher than where the price ended up. So the price target here that's the target. Now you might say, well, if that's the target, then we've got to look in the future where they think it's going. Well, okay, let's look further in the future. They were still thinking up here. And it wasn't there at that point. It was all the way down here. So even if you look at this and say, well, let's go backwards when it's here, okay, fine, right along there. They're a bit positive. Too early. I'd rather wait. I want to show you something interesting. This is maximum drawdown in a portfolio. This is return. This is when we talk about risk and return, which people don't understand. That's return. Everyone understands return. Okay, return's bloody easy to understand. Okay, everybody understands average return. This is the bit they don't understand, drawdowns. Now, in a way, like your house price, it doesn't matter if it goes down because you're not selling it. What the hell do you care if it's gone down today? Do you know what your house price is today, this morning? No, of course not. And if I said to you it's down 20% in a year, you don't say, shit, let's sell it. Okay. So, but look at the direction, look at the perfect diagonal line or effective diagonal line. Wouldn't it be great to have something which has lots of return and no drawdown? This is where they say, well, to business people, well, you're the risk taker, so that's why you get the rewards. That's what they're talking about. Similarly with owning companies. I mean, think about it. A business owner owns a company. When you buy shares, you're owning a company. So in owning a company, the risk you're taking is that you've just got to be able to withstand that drawdown. And I'm afraid drawdowns will come by. But like the drawdowns in your house, and the analogy with houses was created by Warren Buffett, so what? Okay, so if you want the bigger return, now you might say, well, I don't want to suffer the mental anguish of a 27.5% drop just to get 44 historically. I would rather have 30 and a significantly less mental anguish. And that's personal taste. It's like when I go to a restaurant, I don't necessarily like the same food as my wife. It's just taste. Doesn't mean my dishes are better. Well, the returns were better. I mean, hers will be healthier. Okay. But the point I want to make to you is that's what you're trying to work out. What's this that you can tolerate for your mental anguish? There's no point pretending to be somebody you're not. I had somebody I was talking to on the program this week, and he said, don't take this the wrong way, but I want to be like you. I said, no. You want to be like you, not me. How do you know what I can take? What if I'm that guy who can take a lot more volatility? You're soon going to be throwing up. Okay, so these things are really important for you to understand when you're investing. Not just, oh, Alpesh gave some stock names. Great, I've got the stock names. No, because panic and boredom will kill you anyway. I can give you any stock names. Panic and boredom will kill you. Okay, so where are we on what we've done? That's the one my wife and son are in. Now, well, wait a minute, Alpesh, you're some kind of expert. How come you only did that? Well, they're in cash then, actually. So, that was bank interest, basically, pretty much. Well, it was the portfolio, but it was bank interest was about the same. Would have been better off in the bank. But that's 2022, Daddy Bear. Okay, so how come you don't have double that or triple that? How come you don't leverage it? Well, because if the outlier thing happens and the market gets tanked, I can't afford to be bankrupted. That's why we don't leverage it either. That's the killer. It's not this. Everybody's greedy for this. I always say to my clients, assume that'll be half in the future and assume that'll be double. Now, are you still able to sleep easy? If you are, that's fine. A bit like house prices in the 1980s. Think of a portfolio like houses again. If there's a recession and it's out of your hands, it's in Nigel Lawson's hands, going back to the 1980s, it'll take 5 years for you to make the returns you wanted. If there is none and there's a big, massive boom, it'll take 3 years. That's what it is. So how much do you need for retirement? This is one rule of thumb. You can do it mathematically. So these financial planners and IFAs will charge you a bloody fortune. All the numbers and as if life is predictable. And the next day you get hit by a bloody bus because you're looking at their reports and you put your foot out onto the road. Okay. No, you need this. Annual spend times 25. That's what you need. Okay, work it out for yourselves. Done. Job done. Okay. I'll give you some scenarios. If you wanted £40,000 per year gross before tax or anything else, you need $1 million in your pension. If you wanted 60,000, you need 1.5 million. If you wanted 80, you need this. That's another method of planning. Why are pensions good? Well, you might already know this, so forgive me. You put in 80, government puts in 20. This, whether it's your own company or you doing it. Now, of these, I don't do these. I don't generally tend to do those, though a lot of my clients do, and that's fine because I prefer these. I don't do these toxic investment trusts. I mean, it's the massive scam. I don't do REITs because I think you need to be it's a speciality. It's like gold, okay? And I don't do this because the bank does that for me. Okay, if I put my cash with, say, Flagstone and they go and put it with I don't know, the National Bank of bloody Egypt or something, they're giving me 4% because, well, they're probably lending it to someone, but bonds and all the rest of it, probably Egyptian bonds. Right. Now, where are we in the S&P at the moment? Well, I did this, and I think this is a work of art, but then I'm a geek, so I would say that. So let's say that was about March time. We were at 0.3. What's 0.3? It's this. Take a photo of this if you wish. And I don't want my clients to have a heart attack because this is something which has been in my books in the past. So we are. Where are we now? Well, I've just shown you we're at 0.2 at the moment. What comes after 2, Alpesh? 3. When? I don't know. How big will 4 and this fall be? I don't know. So we'll keep an eye on it. Do you see how little I know? It's the smart ass who tries to tell you too much who messes it up, because then they're gambling. Okay, then they're gambling. Now, let's have a look at this. This is what makes my life easier. It's what Warren Buffett also said makes his life very easy. Simply this. The average positive return is 32%. 32%. And 88.5% of the time you get a positive return. So hang on, Alpesh, you're cheating. You're just investing in a market which is likely to go up a lot very often. Yes, I'm cheating. That makes you look really good. Yeah, but I'm not. And what Buffett said the same. He goes, I didn't do it. It was all the companies I invested in that did it. I'm just the lucky fool who worked that out. Now, I'm not trying to copy him. It just so happens I reverse engineered. I chose my own approach. And it just so happens the great genius that the man is says the same. You know why he says? He sometimes lies to tell a bigger truth. And I'll give you an example. He lied that his favorite holding period is forever, because we know, looking at his portfolio, he doesn't hold things forever. Okay. Why did he say it? Well, he wasn't maliciously lying. What he was trying to get across is, if you hold something forever, there are 2 things you're saying. I won't panic and I won't get bored. You can only do that with quality companies. Now, if he said it, well, I buy quality companies, I don't panic and I don't get bored, which he probably has said, probably wouldn't resonate as much. So anyway, I think the great thing about him is he's a communications genius. Okay. Yeah, Darren, Mummy and Daddy Bear. It's very simple. See that pattern there where the green crosses below the blue? That's it. It's the MACD, weekly and monthly, that you're seeing here. The one that I'm looking at here is the monthly, so it's that one. Okay, the monthly is the dotted lines. Ignore, therefore, this, which is the weekly. Just ignore that. And the Daddy Bear. And I've written about this in my book, so I don't want my clients having a heart attack, saying, oh my God, you've shown the crown jewels. I haven't. Sitting here wearing trousers. I've not shown the crown jewels. Don't worry. And you can see where that happens. That's considered Daddy Bear. Now, so you might say, well, what's a mummy bear? A mummy bear is when prices are falling, but the MACD is rising. So prices are falling, MACD is rising. That's a baby bear. You can ignore it. What's a mama bear? Mama bear is where prices are falling and the MACD is also falling, i.e. this is falling but hasn't crossed below its own signal line, like at 0.3. And a daddy bear is when it has. So a mama bear you can ignore. Basically, babies and mamas you can ignore. Don't ever ignore daddy, is what I think. Now, what happens if you ignore daddy? Well, either you'll end, obviously, 2 obvious things. Let's appeal to logic. 2 obvious things. Either you will buy back cheaper or you'll buy back more expensive. They're the only 2 logical outcomes. If you buy back cheaper, well done, congratulations. It worked out for you. Let's say you buy back more expensive, as I had to earlier this year. Well, that's your insurance policy. What if you don't want the insurance policy? Very simple. Ignore the daddy bear rule. Okay? Very simple logic. Well, how do I see if any of this works, Alpesh? I'm not going to take your word for it. Good. Go on Yahoo Finance or Google Finance. Pull this up. It's all free. You can pull it all up and scroll back, and you'll see when it's worked, when it hasn't. What I'd suggest you do is just hit print. Get a nice laser printer. That's what I used to do 30 years ago. And then just print out tons of them, and then with a fine pen, mark, and a ruler. Friday nights is what I used to do. I would drop off the woman I was dating home early on a Friday night, Saturday night, try and get rid of her by 9 o'clock. What an idiot I was. 9 o'clock, and get to my computer and start printing out these until about 3 in the morning and working out the various pattern recognitions. Not just this, there was a billion other things. And then it's in the books, and the books became international bestsellers. There's more to life. But anyway, there we go. Where are we? Now, take a picture of this. This is how you sack your IFA if you want to do things more yourself. All right? If you want to do things more yourself. Okay? That's me. That's, for me, very simple. They say a focused fool is more powerful than a distracted genius. I focus on one approach when it comes to investing. Get asked so much. People think I do something that I don't. They think I have a time machine. I go into the future, see what the world looks like, and then I come back to the present and tell people, nope, not what I do. They think that I'm, a gypsy and I've got a crystal ball, like, the old gypsy ladies used to have. Are we allowed to say all of that? And no, I don't. I don't have any crystal balls. They're real ones. And value growth, income, cash return. Now you might say, where did this come from? So that comes from really the academic research out of, and if you want to see some of it, by the way, it's here. Have a look at it. It's free. If you want to read some of those academic papers on it, 3 people in particular, Daniel Kahneman, Eugene Fehmer, and Richard Thaler. Okay, that comes from Goldman Sachs Wealth Management, Croakey, Cash Return Capital Investing. Momentum comes from the hedge fund industry, particularly the research by AHL, the hedge fund. Sortino, again, hedge fund industry as well. And we need them to be, and Alpha I won't go into, but they need them to be green. Does that mean all of those go up? Nope. Does it mean they'll be the best stocks? Guaranteed that the biggest mover? No, guaranteed the biggest mover of the year will not be in there, because the biggest mover of the year won't meet those criteria. It'll be some really crappy company that Donald Trump's family has tweeted about. That'll be the biggest mover of the year, and we'll never capture it. We're not playing that game, you see. This is 2024. Okay, now, if we were so good, we would have just picked one stock. We're not that good, because it's gone up 515. We would have known not only the one stock, but how much it's going to go up. We don't. We're not good enough only to pick one stock. We're not good enough to tell you how much it's going to go up. Do you see how little we know? And it's through knowing that you know very little that you know you need to have more stocks. I should have been a trillionaire by now, because I should have known only to buy that, or just that, or just that. Don't even know what the hell they do. Okay. And yes, sometimes we cheat because we know that the leverage is worth doing, because we look at the MACD, the momentum, and all the rest of it. Sometimes we're shocked that the thing we thought was going to go up has gone down, and the thing we thought won't go as much as it did actually goes up. And sometimes the one we didn't pick, which is in our filter because we can't buy everything, like Crocs in 2021, goes up loads, and we think, well, bloody ugly shoemaker went up more than the tech companies. So we're not trying to predict the future. Okay, it's a fool's game, sadly, to try and predict the future. For a start, you never know who's going to be bloody president. Okay, time to double your money. Now, here's an interesting thing. It sounds greedy and it sounds silly. 5 years, if it's 15% per annum, that in actual fact is the S&P 500 return over the last 15 years in sterling terms. So I'll take credit for that, but it wasn't me. It was the market. It wasn't me. It was Walmart, Costco, whoever. Okay, it was Broadcom, it was ServiceNow, it was Salesforce. Okay, it wasn't me. Is it worth the effort to try and reduce 5 years into 3.8, i.e., shave off 14 months, roughly? Is it worth it for the extra risk that might imply? You might say, well, no, you put it into perspective now. I shouldn't let greed trip me up. Remember that. For those of you who are aware of the Great Investments Program, let me know if it's the first time you're on it. What I want to do with it is eventually float the whole company and make it global. We've already got clients from Australia, New Zealand, US as well. And what I do is take people in groups of 10, because it's manageable then, and give them lifetime access to all the data and me. And somebody asked me, what happens if you fall under a bus? They didn't quite put it like that, but it's what they meant. I said, well, we've got a company which continues to provide the data. And here's the brilliant thing. All the education and the model portfolios, they're easy for my team to replicate, even if I'm not around, and put out there. But the calls with me wouldn't be there. So we've now trialing, and I think it's going to work, a little AI thing, which has all my materials, all my books I've written. Luckily, I've written shed bucket loads and all the videos. And we asked it questions. And it gave answers, which not only did I agree to, but there were better answers than I gave, if you see what I mean. So the AI version of me was better than me. So even if I fall under a bus, we're safe because you get the data and you still get the person to talk to. In fact, they might not even realize. I think now you can even do it so the voice is the same and the image. I mean, I'm not even here. I don't know if you know, this has been a whole AI image all along in this webinar, which has done this entire webinar. It's incredible the technology is that good. I just wanted to let you know right now. Yeah, the AI clone. I am actually a clone. They call me Dolly. So yeah, if you want to join the program, it's there. That's where you go. Do join. We've now got, as well as that, model portfolios. So I want you to think of this as a recipe card and ingredients. And you might say, I don't want to make my own cake. I watch Bake Off like the next person, but I don't ever bloody get up and go in the kitchen after it. I'll go and get a cake, which has been ready-made, and feed my fat face with it. So that's the equivalent of a model portfolio. It's where we've made the cake based on the filters. And then you say, well, can you take out the sprinkles and add more sugar? And we go, okay, let's play around with it, see what it looks like. And then we make another cake, and that's your bespoke cake. So that's what the idea with the model portfolios is. And then people look at the historic returns on them and so on as well. I'm going to see if I can pull something up on that. I might not be able to. So I'm going to answer some questions. Whoops, let's see if I can. I might not be able to. Yeah, it should be on there. I think I've got a folder. I'll give you the link to the folder, actually, because the folder, if I can, yeah, actually, I've got a whole link to a whole bunch of folders, which shows you some of the, how we show you the results of some of the models. Let me see if I can show it on screen for the moment. Okay, so sort of the breakdown. Now, this is the important thing. So you can see the historic performance and all the breakdown, all the data, and I explained this to people. So they can see what their model portfolio suited to them, bespoke to them, like a bespoke Savile Row suit, because everyone's got different appetites. So they can see, and this is the important thing, and they never say it, but I'm sure they must be surprised how much I focused on the downside, as it were, the drawdown. Because they've got to survive that to avoid the panic to get the whatever, 20%, 15, 30, 40%, whatever it is that they're targeting, but historically has been achieved. Now, I'll tell you the other thing, which is really important, underwater period and recovery time. Now, the way we got this was that's what you've got to show as a hedge fund manager to institutions that you're looking to get money from. If you're looking to get money from Aegon or AXA or whoever, whichever big institution, you've got to show them this. And all we did was take what we have to show institutions and bring it to retail clients and say, well, wouldn't you want to know this? And it's amazing that nobody bothers ever pointing these things out. What they say is, oh, no, invest with our fund and we are very rather clever fund manager. We'll be able to sort of navigate the markets. Well, that BS. But we know that's wrong because Eugene Fama got a Nobel Prize in economics for proving that fund managers will institutionally underperform the markets, because they pick from a narrow gene pool and they follow narratives and stories because the marketing requires them to. Because if you showed this on marketing, people go, oh. Okay. And you might say, well, wait a minute, how come you've got companies which have performed? Because we're not cherry picking. We're picking based on filters and then seeing how they performed, not seeing how it performed and then saying we'll have those. That'd be cherry picking, that'd be curve fitting. We look at where we are today and say, right, these are companies we like going forward. We say, let's just see what would have happened historically with them anyway. And we go, oh, actually, yeah, pretty bloody good. And some of them won't be. And you go, oh, no, this one was crap historically. It doesn't mean we take it out, because then that'd be curve fitting and being selective, which is pointless because we're only kidding ourselves if we do that. Anyway, We break it down. I'll give you this link. Wanting to float this for several years now. What's preventing it? Size and scale and time, really. I want to do it at the right time, not when it's too small. So I spoke to the London Stock Exchange last week, and I don't want to do it when it's just tiny and get stuck with illiquidity. I want to do it when it's massive, because then you make more, basically. If you look at when Palantir floated, it was already making massive global revenues, and that's when it floated. So that's the reason. You could do it tomorrow. My father floated his company, and it on the Mumbai Stock Exchange many years ago. And I guess one of the main lessons I learned from that is if you the longer you can wait, the more beneficial and lucrative, etc., it is. Now, before any of my clients have a heart attack over, saying, "Did you just give?" No, I didn't. What the link on Google Drive there is fine. Oh, thanks, Ravi. Oh, Ravi, you've done that private. I'm going to do that public. Ooh, can I do that public? Broadcast comment to room. Any other questions? Has anybody got? Oh, that's weird. Wonder what happened there. Oh, and I'm going to share some files with you as well, actually. I want to share some files with you, including a copy of my book. Let me just go backwards. I don't know why the presentation's done that, but it has. There we go. I also want to share something else with you. By the way, I don't want to float it just because my dad floated a company and it's rather successful out in India. And I deal with floated companies all the time, so I'm not thinking FOMO. Why haven't I got Microsoft? It's just, it seems the obvious thing to do is to do that. So that's the ultimate ambition. Not that anybody cares what my personal ambitions are. Any other, let me put it this way, any other questions? Thank you very much again, like I said, Ravi. What I try and do, actually, you raised an important point, Ravi. I'm going to share some other stuff because you've mentioned the other points. There's a bunch of increasingly more free content that I've put on here. Again, I don't want clients to have a heart attack thinking, did you say free? There are things you can give people to build up their education, which is important for me to do that and get that balance right. So if you have a look at all of this, including you must know your investment persona, that's really good. So have a look at some of these things. That's the best place to go to for all of this, actually, is alpeshpatel.com/links. If you just remember nothing else but that, you'll be fine. Raj, would you say leverage is less risky even for us common folks if we enter after a bear market? No, Raj, I couldn't make that comment. I couldn't say it's less risky at that point at all. Statistically, I'd have to look at it and I'd have to be confident. Is now a good time to buy 2 times S&P 500? No, Marcus. And I say that because I don't know who you are. And I would always say to people, don't do leverage when I don't know who they are. I don't know their risk appetite. I don't know their personal circumstances. And you've just given a very good reason why you might not want to do it. Market too overbought. I don't know your appetite. It's a good time for me. Because most times are good times for me, as you've seen. The markets tend to go up, okay? But I couldn't say to you it's a good time for you, because a week from now, I mean, you might say, yeah, well, what I did up, I was just on my house. I put everything into 2 times average S&P because you said it's a good time. Forget that you said it up, I thought I did. And now the market's down 10% in a month, and I'm down 20%. That means I've just lost 200 grand, Alpesh. That's not a good time for you. And what if I turn around and say, well, to make the pain go away, exit? And you do, and then it goes up 30%. And you go, but it went up. Why do you tell me to exit? Well, because you were throwing up in the corner. Do you see what I mean? It's a lot more than is it now a good time? Okay. What about 2 times S&P is 5% portfolio have high risk? From what you've said, Marcus, and I can't give you financial advice, obviously, because it's illegal to give you financial advice on that. From what you've said, let me give you the negatives of what you've just done. You might still panic. Just because it's 5%, you might still panic. People do. You're not going to believe this. I'm going to let you into a secret market. And it shocked me. And I could only find this out by experiment. I know people who, if they lose 10% on a stock, they will panic, even though 10% is £100. It's not the actual amount of money they put in, they panic on. It's the size of the fall and the percentage, because the brokers show you the percentages, not just the amount you've lost. And people panic. Why do they panic? They panic because they say, well, why should I lose £150? I mean, if I came up to you today and said, oh, I made a mistake, you need to pay me £20 more, you'd haggle with me, wouldn't you? You'd haggle with me over £20 or £5, or why would you waste money? So they feel they're wasting money. Maybe panic's the wrong word. So it's not that you're going to put in 5%. So I'm going to let you into that secret. That's the first thing. The second thing I let you into, I get people saying I've got high risk appetite on a scale of 1 to 10. And I have never met a single person who says they're a 7 or 8 risk appetite, i.e. 10 means higher, 1 means lower, who is actually who is not 2 degrees lower. So a 7 is actually a 5, and 8 is actually a 6. So when you tell me you're high risk appetite, I would happily take a wager. No, you're not. No, you're not. You're going to behave like you are, and then the S&P is going to drop 10%. You're going to be down 20%, and you're going to discover you're not. I don't know you. Do you know why I can say that? Because I've met enough people. And you might say, Alpesh, you're completely wrong about me. Fine. I'd rather be wrong about you and than say to you, yeah, go ahead, knock yourself out. And you might say, you're boring, Alpesh. You're not letting me have fun. Just telling you the way I'm seeing it. All right? Just telling you the way I'm seeing it. I'm not the guy you want to go out with on a Friday night for a drink. I'm the boring guy, I'm afraid. Not just with investing. Yeah, that's me. On all of that. Now, I'm going to show you something else. I want to show you. This is the page. Alpesh Patel. Boom, 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 boom. Links. That's where all the free material is. Okay, tons of it is on there. Okay, tons and tons of it. You'll love it. I'm going to make sure I've shared all the files. No, I've got some more to share as well. Any other questions? Otherwise, I will go. I apologize for the sound problem. I'm going to try and test this sound in future. Does it matter in the long term which S&P ETF we buy? Patel and Hedge. I've never bothered looking at it. It's probably something I should have. Do I want it hedged or not? Because in the bigger scheme of things, I just thought to myself, I'm making the money. I'm not going to try and work out. It's like asking, does it make a difference if you go between SIP providers and brokers? Is there going to be much of a difference? So we'll see. We'll see. Oh, and by the way, one of the things I'd suggest you do, feel free to follow me on LinkedIn. The reason I say that is I often put quite a few good articles on there on LinkedIn. And I've broken 27,000. I didn't have that. I had 26,000 something. Okay, LinkedIn gave me a top voice. I'm very, very pleased with that. Very proud of that. And you will see there are quite a few articles. And by the way, including one that I did today, we created a pension calculator. It is lovely. It's on alpeshpatel.com/links. I'm really pleased with this. Let me show you the pension calculator. There we go. Now, although it says dollars, you can do it in anything. Great investments program, pension calculator, blah, blah, blah. And you can put in different ages and everything else. Okay. Sad to see that your old TikTok posts were they? Which ones? Sarah, you're getting me scared. I was sad to see that your old TikTok posts were removed. Where from? TikTok. When? I've not done anything. Let's have a look at my TikTok account. Sarah, you're either playing with my mind or something. It might be that you've gone to the wrong account because there's quite a few people pretending to be me. Let me see. Should all be there. So that's me on TikTok. Whoops. Yeah, that's me. Blue tick. There's a lot of people fake pretending to be me. And no, they're all there. They're all there. I think so. Okay. I really like those. I thought these would get more views, but they didn't. I haven't been. Thank you, Jubin. Saw this on Telegram channel. Thank you. This is brilliant. Thank you. I've been able to jump on for months. Great as always. Thanks, Richard. I'm delighted. Anytime. I enjoyed seeing all the value, various advice you give us in investigations. Gone. No, Sarah, it's all there. I think, Sarah, maybe you might have jumped onto the wrong channel, because sometimes you just put my name in. There's a lot of fake things. Look, like various locations. It's all visible. In fact, I had a call with TikTok yesterday. I don't know if you know, I did some adverts for them for their small business stuff, because they contacted me. They said, will you come into TikTok headquarters in London? I did some videos from there for them and then rebroadcast them here as well. So I was really pleased with that. So yeah, no, it's all fine. 2022 and 2023 posts. I'll have a look later, but unless TikTok removed them after 2 or 3 years, I can ask them. My God, that's going back a long, long way, though. I mean, we'd really have to go back. I'm trying to think. But anyway, thank you. There's a lot of stuff on TikTok, as you can see, of mine. But this is probably all still this year. I won't be surprised. So I don't know. It'd be a lot of scrolling for me to go back to 2022 and 2023 posts. But I've not removed them. It might be that they have some kind of mechanism where they get rid of the old stuff. Which would be a shame, wouldn't it? As well. So there we go. People sometimes ask me questions on TikTok, but I prefer that they email me, because it's a lot easier. That was just November wasn't that November? When did I go to Nashville? That was when I was in Nashville. I went to see my sister who lives out in Nashville. So I can't scroll back that far. If you're scrolling back that far, Sarah, well done, indeed. But that's when I was in the States. So was that March of this year? No, sorry, this is February of this year. So all that scrolling, and I only got back to February. Okay, thank you all, and I will hopefully speak to you all very soon. And if you've got any other questions, do email me. Feel free. alpeshpatel.com/links, where you'll also, as I said, find this. You will also find a whole bunch of articles and so on. You will also find on there everything you could want. Okay, so there's a ton of materials on there. Thank you all very much. I will again apologize for this audio problems. I will check them in future. No idea why that. Well, I sort of think I know what happened, but yeah, we'll check that in future. Thank you all very much. I hope to speak to you soon. Thank you.